All right, we will go ahead and get started then. So welcome everyone to the third webinar in this series from Interaxis Plus. As I was telling Ryan before, our goal here is those of you that are in the financial services profession, whether you're financial advisors or accountants or bankers or whatever, and you understand crypto, you have some base level of knowledge of crypto. Our goal here is to keep you up to date, with what's going on, because we know once you've learned it, that's kind of the hardest part, is keeping up with whatever's happening, either from a regulatory perspective, sometimes from the perspective of what's actually happening in markets, what is out there that's new, and most importantly, how does it pertain to you as a financial professional? So with that in mind, we went to one of the top companies out there in terms of offering products and services around crypto to financial advisors, which is Bitwise. And we got Ryan Rasmussen here, who is the DeFi, head of DeFi analyst. I'll let you, Ryan, I apologize. I butchered that a little bit. I will let you talk about what you're doing there at Bitwise, your role, and go into a little bit about your background. And once that's done, we'll go into whatever we're going to discuss, what's on the agenda for us in the next hour.
Awesome. Thanks, Adam. And thanks everyone for joining. Looking forward to having this discussion and happy to be here. As Adam mentioned, my name's Ryan Rasmussen. I am on the research team at Bitwise Asset Management. I specifically focus on DeFi, but our team is relatively small and well-versed in the different topics across the crypto ecosystem. So we all do a little bit of everything, but yeah, happy to be here and talking about DeFi today. And like I said, I'm part of Bitwise Asset Management. We are the world's largest crypto asset management firm. We launched the first crypto index fund in 2017 called the Bitwise 10. And that's based on the top 10 crypto assets by market cap, just kind of like a passive approach. And then we have a handful of indexes as well that are sector specific, like a DeFi index, an NFT index, a top 10 assets excluding Bitcoin, because Bitcoin is such a monster in and of itself. And yeah, we as well, similar to Interaxis, work with a lot of investment professionals in helping connect them to the crypto world, whether it's personal interest of their clients, or they want to understand how crypto fits into a portfolio. So happy to be here to talk specifically about DeFi. But yeah, thanks for the opportunity.
All right, thank you so much, Ryan. So what we really want to get into here eventually, we're going to have to set the table a little bit, but what we want to get into here, and you brought this up as a topic, and I love it, is the resilience we've seen in DeFi over the last few months. And you brought it up, when we started talking just before this, about how the first time you and I talked was probably in like March or April, as we joked, when everything was really calm, nothing much going on in the crypto world. And then kind of all hell broke loose. And what we've seen is this resilience of the decentralized finance system. So we definitely want to talk about that. But before that, you had sent me over a few research articles or a few research reports that you all had done at Bitwise that you were a part of. One of them was about stable coins. One of them is about the DeFi system overall, and risk management within DeFi. So let's go back real quick and talk a little bit about stable coins, because obviously we can go back and talk about how this kind of downturn started, above and beyond what's happened in correlation with NASDAQ, but how this downturn started with Terra, and then how it has progressed through poor risk management in the CeFi system. So let me ask you and let you talk a little bit about stable coins and where we're seeing them fit in the DeFi ecosystem, and what's good and bad about what's going on with stable coins right now.
Awesome. Yeah, love talking about stable coins. And we've done some extensive research, particularly in the past few months. As you mentioned, stablecoins have become such a large topic of discussion, given everything going on with the crypto credit crisis and the death spiral, so call it, of Luna and the UST stablecoin. So happy to kind of set the stage there. It's definitely one of the killer apps of crypto, even though some find it maybe not that exciting. Stable coins are crypto dollars, right? So they're dollars enabled for the blockchain. They can be sent, transferred, settled on chain. And And because of that, they've become a very integral part of broader crypto markets, but specifically DeFi, as users kind of expand beyond just trading crypto assets to the other financial services primitives that are out there, like lending and borrowing, asset management, and then obviously some more kind of derivative and longer tail strategies. And so, yeah, stablecoins are huge. They have over 150 billion in total supply or market cap. So, that number has grown to be a relatively large number within the broader crypto economy. And they weren't always that big. Stablecoins are a relatively, new primitive, given that they are blockchain native. But even still, the first stablecoin, which is Tether, really, or USDT, launched 2015, 2016, but really didn't start seeing traction until a little bit in 2017, and then really beyond into what we call DeFi summer, which happened in 2020 and beyond. And so the trajectory of stablecoins is one thing that's very impressive in and of itself, just from a growth perspective. Setting the stage on the different types of stablecoins that exist, which again are just crypto dollars enabled for the blockchain. So you have one US dollar that's going to be equivalent to one USDT or one USDC, and then you can go and trade, deposit, borrow, and use that dollar in the crypto ecosystem. The three different types of stablecoin supply that exists are the fiat-backed stablecoin. So that's really the one that I think is simplest to understand for those of us coming from traditional markets, right? There are centralized institutions that will issue a USDC or USDT, which is a fiat-backed stablecoin, to investors who will deposit a US dollar. So breaking that down, I'll go to the Tether Foundation and deposit one US dollar. They'll give me back one USDT, and then I can go use that USDT in DeFi. The fiat-backed model is generally one that is one-to-one backed, meaning that for every dollar that you deposit with one of these centralized institutions, they hold a dollar in their reserves, or a dollar equivalent. That's where you start to get into some of the nuances around what is really behind these fiat-backed assets. Get into the same thing on crypto-backed and algorithmically backed as well. So would love to dive into some of those reserves, but first, still setting the stage, I guess, on the type of stablecoins is the fiat-backed, which is backed one-to-one with US dollars, cash equivalents. The crypto-backed, which you may guess is backed by other crypto assets like Ether or Bitcoin, or ironically, in some cases, backed by other fiat-backed stablecoins. And that's like DAI, for those that have heard of DAI, which you deposit maybe $150 of ETH into a DeFi protocol, and you can take out $100 of DAI. That's how you have this crypto-backed stablecoin. It operates on an over-collateralized model generally. That would be to account for having non-stable assets as reserves, right? Because ETH and Bitcoin as reserves behind a stablecoin, they are volatile. So you have to create an extra collateralization buffer to account for market sell-offs, which we'll definitely get back to. And yeah, the third is algorithmic stablecoins. Those are probably those are definitely the most experimental type of stablecoins out there. People may have heard of Terra USD or UST, which is the most infamous stablecoin, having wound up in a death spiral that kind of kicked off the broader crypto credit crisis that we're seeing the dust settle on today. Beyond the macro environment, obviously. And so yeah, those are three different types of stable-coins. Algorithmically backed are kind of backed by a formula that aims to stabilize the asset versus being backed by specific crypto assets or US dollars. And so you start to get into whether that algorithm or the stability mechanism is really something that is sustainable. And we've seen in the past that we've not been able to figure that out. So
we talk a lot when we teach our courses about how DeFi is so much built on incentive mechanisms, right? You're trying to give people the incentive to do certain things, and hopefully the incentives are right to have certain protocols and certain assets behave the way you want them to. And that's kind of that's both the crypto collateral backed stablecoin and the algorithmic stablecoin are kind of doing that. The difference is one of them, the algorithmic one, provides those incentives in a way that is not necessarily backed by anything. Right. It's just we will either deposit some or take some out based on, maybe some oracle that tells you what the price is, versus the crypto collateral, the DAI, which basically says, we hope you will deposit your ETH and borrow some DAI. And then if the numbers say so, you will be more likely to pay back the DAI, which we will burn, and therefore we will have less of a supply outstanding, and that will kind of make it worth $1. But we still have that backing, right? The value of ETH drops, 25%, doesn't matter. DAI is still worth what it's worth. It's still ideally worth $1.
Yeah, exactly. I think that was a great way to kind of break that down. And yeah, incentives play such a huge role in all of crypto, but specifically in these more nuanced stablecoin design that aren't just like give $1, receive a crypto dollar. And yeah, I think that's exactly right. The algorithmically structured stablecoins rely more heavily on incentives, and unfortunately, just given how volatile crypto markets are, we've seen that those incentives aren't sufficient to guide the behavior of market participants in times of like extreme volatility. And so what you see is that maybe while, like, if we talk about Terra USD, if that's okay for a second, I think we can kind of help break some of this down. So Terra USD or UST was the algorithmic stablecoin that was part of the Luna or Terra blockchain ecosystem. And it really rose to popularity in the last half of 2021 and the first half of 2022. As a lot of alternative blockchains outside of Ethereum were raising or growing in popularity during that time, it does make sense that the application layer and other elements of those ecosystems also experienced similar growth. And so, we saw alternative layer ones blowing up last year from a growth perspective and the first half of this year. And with that, we saw this algorithmic stablecoin kind of, really take off. And the supply of UST, I guess for to contextualize this, it grew to 20 billion in supply. So if total billion at that point, I believe, was around 175, or total supply was around 175 billion, and UST grew to 20 billion, it was a decent size, right? And so that's important because a lot of the ecosystem around UST was propped up by these incentives that we're talking about, right? So the reason why I, as an investor, would be more incentivized to go and acquire this UST or algorithmic stablecoin is because I could then go deposit it into Anchor, which was a lending protocol on top of Terra, and earn 20% yield, right? So who wouldn't want to go buy I'm going to quote unquote the stable element of this, right? But a stable coin, or take your dollars and go exchange those for stable coins, drop that into a lending protocol, and you're earning a 20% APY, especially as the broader like market backdrop is all-time low interest rates, and fear of inflation, right? People are trying to hedge against that, and a 20% return on your stable coins is really attractive. The problem is that 20% wasn't really a natural yield, as people can imagine. It was being incentivized by the broader Terra and Anchor ecosystems, and so they were essentially subsidizing growth, right? You think about how companies like Uber or Snapchat or Insta, like any of these tech companies, will offer services for free, or even like give you a credit to use their services, right? Like Uber will give you a free ride if you refer someone, or will give you your first $10 free when you sign up, right? That's a way to kind of acquire you as a user. That's coming out of their budget, right? It's a user acquisition cost for them, but they're willing to do it. The same thing was happening in the UST, Anchor, Terra ecosystem. They were paying for users to come and acquire the stablecoin, deposit it in their lending protocol, and they would, receive a yield. The reason why we found that incentive was unsustainable is because, at some point those user acquisition budgets do dry up. And at the same time, a large part of the continued growth was driven by hype around the stablecoin itself and the ecosystem. So the foundation behind UST decided at one point they were going to buy billions in Bitcoin and use that as a reserve behind the asset, right? So now we see this hybrid between it's part algorithmically structured with incentives that help determine what's the supply and what's minted and what's burned and stabilize the price. But also, in case of an emergency, there's this Bitcoin sitting behind the stablecoin that can be sold into the market, right? And UST be bought that help stabilize the price, creating demand for the stablecoin. The reason why that isn't sustainable, as we've seen so far, is that we saw somewhat of a bank run occurring as crypto assets and broader assets started to fall as part of the macro environment was I guess taking over the narrative. The price of Bitcoin started to fall. People started to try to redeem their UST for the original crypto assets they put into the ecosystem, but those original crypto assets were also falling. And that's where we have this death spiral that was created by this algorithmic and incentivized structure where on the way up, everything is working great because there's more and more liquidity and more demand than we need. But as things start to unwind, as the value of the reserve started to fall, and as stablecoin holders went to go redeem those reserves, you have a bank run effect, which ultimately results in the UST stablecoin falling from $1 to like 10 cents over a few days. And the reserve assets, both Bitcoin and Luna, falling significantly. And alas, we had a $60 billion blow up between Luna and UST.
Started us down this road, right? Because now you had the price of, well, one, you had what, 20 to $40 billion totally erased, right? Because that was Terra was worth, I think, $40 billion before this started.
Right.
And you also had the fact that they had to unwind a couple $1 billion worth of Bitcoin, right? Selling that on the market at a time when there weren't a whole lot of buyers. There weren't a whole lot of people going, man,
right,
price at Bitcoin. There were a lot of people going, no, I'll wait for it to drop $10,000 more, right? That it was, if I remember correctly, it was around 30 or so. And a whole lot of people waiting there going, yeah, I got a whole bunch of dry powder on the sideline waiting to buy more. They're going, no, if it's
right
here, I might as well let it go and buy it up at 20. So you had a whole bunch dumped on the market at a time when there weren't a lot of buyers, which catapults us into the next phase, which is all the CeFi, I don't know, call them exchanges, we can call them whatever we want. They're hedge funds.
Right.
That were, again, not practicing good risk management, I guess.
Yes.
So we can get in and talk a little bit about that. But the most important part is what we're learning about risk management in the DeFi space that is not existent in the CeFi or traditional finance.
Yeah, absolutely. It definitely highlights this concept of transparent risk management, just the approach to risk management in general that different traditional institutions will take versus decentralized or fully transparent DeFi applications. I think it's exactly right when people are sitting on the sidelines waiting to buy Bitcoin when it falls from 30K to 20K. One thing they're absolutely not doing is buying the algorithmic stable coins that are also backed by that Bitcoin, right? I mean, it kind of feels obvious in hindsight that stability mechanism didn't work as things crashed. And yeah, that kicked off this broader, crypto credit crisis. You can't really call it a recession necessarily, given like we really know what it was triggered by. Obviously, these macro factors play a role, but the great unwinding of centralized finance that happened really did start with Luna UST. And what happened thereafter is that we found there were a bunch of the leading centralized finance or CeFi firms, which are basically like crypto fintech companies that offer crypto products to retail or users generally, or investors, but they kind of handle the actual deployment of capital into the crypto ecosystem, right? And so when we talk about DeFi, we talk about going in directly into the ecosystem, custodying your own assets, deploying them and controlling them on your own. A lot of people aren't comfortable doing that, so they go through these centralized institutions like Coinbase or BlockFi or Celsius, that people may have heard of. And what we found as markets crashed and the price of Bitcoin fell, 75% among all other crypto assets falling that much, we had the UST stablecoin blow up, was there was a lot of exposure to these longer tail assets by these centralized finance institutions. Then I want to say was assumed across the broader ecosystem, and may or may not have been very transparent in what the companies were putting out as far as what they were doing with customer funds. And yeah, let's get into it a little bit. Would it be helpful to kind of talk through 3AC and Luna in general, starting at May? I can kind of give a brief overview of that if that's helpful.
I think briefly to show the kind of trickle down effect. Steve and I did this a couple weeks ago where we kind of went through some of it, but I would love to hear it from your perspective, being the analyst, and because I didn't get into the specifics, right? I didn't look into the books of 3AC. I wasn't looking at the wallets and seeing what all was happening. I kind of saw it after the fact. And I think an important point to highlight here, Ryan, is there were several people, whether they were on Twitter or wherever else, pointing out these issues before, well before they happened, right? We've talked about the transparency, and we'll get into it with the resilience of DeFi, but and you just alluded to the transparency, right? There were several people pointing out the issues with Terra, right? A lot of it being this algorithmic stablecoin they built can be gamed, right? Some of them even said, here's the blueprint. Here's exactly how it could be done. Here's what would happen if it lost its peg. Here's how the death spiral will happen. Same thing happened. People pointing out the issues with Celsius, the fact that they're completely non-transparent. Here's what they're actually doing with their money. Look, we can find where their wallets are. We can see what they're doing in DeFi, and we can see where the risk is. And so I think it's really important to point out that even though a lot of this is centralized, we kind of know what some of the wallets are. People were pointing this out ahead of time, and no one was listening, or very few people were listening.
Absolutely. It is really fascinating to see that this is probably the first time in history where such a large scale crisis has evolved, where the broader market participants had some level of insight into the actual holdings and movement of assets by the centralized players. If we think back to other credit crisis or financial crisis that exist, there's generally a shakeout that occurs, and months and months later, right, we're kind of finding where everything's falling and where the dust settled, and maybe don't find everything out. With blockchains and with the DeFi and crypto, every transaction is viewable on this public ledger that anyone can search through and not only search through on your own, but reference other work done by other, crypto curious folks who are also doing this forensic analytics or detective work to try to figure out, like, is that a wallet held by 3AC? Interesting. Did that wallet that had the billions of Bitcoin reserves, which they held, did that sell the reserves? At what point did it sell it? Or with Celsius, right? Like, they had a position on Aave that people had been aware of, was Celsius wallets. It was one of the larger positions on the Aave lending platform, right? And there was a ton of commotion on Twitter as people just were speculating or really calculating, like, how far do crypto assets have to fall before this giant centralized company gets liquidated and becomes insolvent? I mean, it was really, really scary, but fascinating to see this all unfold in real time. And so, yeah, going back to May, the beginning of May is when all this started happening. So the first week of May, the UST stablecoin that we talked about started to lose its peg to the US dollar. Over the next week, so called the middle of May, the price of Luna, which was the token behind Terra and partly what backed the UST stablecoin, fell by 96% in a single day. I mean, which is a crazy drawdown, but also not something that hasn't happened before in crypto. We've seen 90% price drawdowns. It's kind of shocking that these design mechanisms are created with that knowledge, but somewhat ignored. And that's where you had these evangelists on Twitter saying, hey, this is a recipe for disaster. We just need the right factors to all be at play at once. And so we saw, May 8th, May 12th timeframe, we saw those factors really come into play, and the stablecoin crashed, the reserve asset crashed, macro environments were also crashing. So outside of this, we had retail users selling, institutions selling, all this downward pressure. Ultimately, there's a couple big firms at play. So Celsius, which was a centralized finance lending platform, was one of the big players that was part of the commotion. Three Arrows Capital, or also known as 3AC, was another, I want to say probably like primary primary factor in this larger crypto credit crisis. And you referenced how we call them CeFi, but a lot of these firms were acting like hedge funds, and I think that's very accurate. 3AC, obviously was a hedge fund or is a hedge fund. Now I don't believe they were doing a good job of hedging their risk as hedge funds are intended to do. They seem to be making directionally long, bullish, leveraged bets on crypto. And so, but they are a hedge fund. And basically what had happened is they had invested a ton of money in Luna and Terra and the UST stablecoin, and they were one of the largest crypto hedge funds out there. This is a hedge fund, 3AC, that grew to up to more than 10 billion in assets at its high point earlier this year. And it's these a couple traders named Kyle Davies and Suzu who previously were traders in TradFi and launched this fund and grew it and really were viewed as some of the thought leaders. Now they were a little bit more brazen than others, but they really viewed as kind of like thought leaders. And there's this term in crypto like giga brains, right, where it's just like, wow, they really have a hold on markets, and like they keep making trades, they keep winning. We talk about internally a little bit of Bitwise. It kind of reminds our team of the long-term capital management group from the 90s. For those who remember that, where you just had these PhDs and like Nobel Prize winners and coming together, and everyone's like, wow, they really can't do anything wrong, and whatever they touch comes to gold. And so the reason I bring that up is because so many other firms wanted to deposit money with this 3AC hedge fund because they were returning just crazy gains. And so 3AC, this hedge fund, kept borrowing funds from Celsius, from BlockFi, from Celsius, from Voyager, from Genesis, which are these big kind of like centralized finance institutions that participate in crypto, all lent money, and most of it on a collateralized basis, but some of it on an under collateralized basis, to Three Arrows Capital. Three Arrows Capital then put a lot of that money into the Luna and Terra and UST ecosystems, which we know crashed, and that basically led to a giant unwinding of leverage. Unfortunately, the firm went quiet mid-June. So all this happened, and as you mentioned, everyone could kind of see the signs on chain, because we did have an inkling of which wallets were whose, and also you have these really loud, outspoken hedge fund managers that all of a sudden go quiet when we know one of their largest investments drops 95%. That also kind of didn't kind of smelled a little bit, and so they went quiet. We started to hear about these centralized firms like Celsius, like Voyager, like BlockFi, needing bailouts, or just freezing customer funds and declaring bankruptcies.
And theirs was less about Terra, right? I mean, theirs was more that everything in crypto started coming down, which was their collateral, right? When
yes.
In ETH and DeFi tokens and everything started coming down in value, which they were utilizing as collateral, and was not necessarily liquid at the time. And
correct.
The was I, as the investor, had bought Bitcoin, and I would deposit it with BlockFi or Celsius or something, and they would promise me some returns, and then they go invest that in something else that is risky.
Mm-hmm.
And they're attempting to kind of do the same things as 3AC, which it says we're going to use the funds we have, we're going to get leverage, we're going to utilize leverage, we're going to try to buy more, and to try to earn more than we promised our depositors.
Mm-hmm.
So we can make some extra money on it. And there was this idea of everything's always going to go up. It's always going to go up. And even if it goes down a little bit, we'll buy the dip and it'll go up again. And it was surprising to me that there was so little realization of the fact that crypto overall, Bitcoin, no matter what it is, had never been through an economic situation like this, right? It had never been through a time of this kind of inflation, of an actual war going on elsewhere in the world, right? The size of this war, right? Like with a country the size of Russia, there's wars going on all the time, but we don't hear about them, right? But this is kind of a big one. Cutting off an entire country that size from the financial system. Crypto hasn't been through that, and the realization of we might get tested a little differently, and everything's not always going to go up, didn't seem to play into it. Even more so with the fact that in my mind, and you've, I'm sure, read the screenshots of these texts and Telegram messages and everything with the Three Arrows Capital guys. It was basically like, hey, do you guys have enough collateral for this loan? And they'd be like, yep, we do. Like, all right, sending you the money. But that was the extent of it. Ironically, on a system that's supposed to be so transparent. That's what it's built on. And yet we went right back to 2008. Exactly.
Yeah, that's such a good point. I feel like one of the things in the broader mainstream media coverage of this unwinding that's happened, one thing that has generally not been made clear, but really should be made clear, is that these CeFi companies, while they use crypto products and invested in crypto assets, those aren't the crypto applications and the use cases for crypto that majority of evangelists are talking about on a day-to-day basis. Meaning that, yes, DeFi lending protocols are absolutely game changers, but having a company that takes dollars from clients and then invests those through taking leverage in DeFi protocols isn't the use case that we're talking about, if that makes sense.
They were 2007, 2008 banks and insurance companies, and they replaced mortgages with Bitcoin. That's all they did.
Yeah, exactly. That's so accurate. And a lot of their trades. So it's, yeah, exactly. It was, they took leverage trades on super volatile assets. They also were trying to take advantage of these arbitrage trades, with GBTC, which is the Grayscale Bitcoin trust that was trading at a large discount. And so like a lot of their, to your point, like it wasn't just them investing in these assets like Luna and UST that caused them to fall. It's the fact that some of the collateral that those loans were taken against were highly illiquid, or were betting on going up or reverting to a mean that during this crazy crisis that we saw just wasn't going to happen. And they became highly illiquid. I believe that I for some reason right now I can't remember if it was Voyager, but I think it was maybe Voyager that ended up seizing the GBTC as collateral from 3AC. But now they're sitting with heavily discounted OTC wrappers on this asset that still is down so much. So it really was reminiscent of taking products that have derived derivative value products and winding up leverage against them and hoping that liquidity would continually exist. And we saw that it quickly dried up. Yeah.
So let's take that and we can go and cause it kind of a positive realm now and go, okay, all this negative happened. Here we are. I mean, and this has only been a couple months. This wasn't like, the 2008, 2009, which took the course of a year. Like this happened really fast. And when it's all algorithmic and programmatic, it can happen really quickly, right? And when it's happening 24/7 all over the world on different exchanges that are on with the most liquid asset ever created, it happens a lot faster when you don't have to end on Friday and start again on Monday. So
right.
It can happen at super speed. But now what we've seen is a lot of resilience in decentralized finance. We can talk about that. And part of that is due to the risk management system that is built into DeFi. So whichever direction you want to go with it, we can talk about the contrast of risk management between CeFi and DeFi, or we can go with the resilience or both. But we have talked before, and you've seen a lot of people spin it positive, which says the DeFi system has worked exactly as it's supposed to.
Yeah, that is super interesting route to take this down, because you just have to unbundle, like, yes, there was a crisis in crypto. What was it driven by? And how did the underlying technology perform? So we've gone through, like, yes, there was a crisis. We've gone through what it was driven by, but let's talk about how the underlying technology, which really is this DeFi, lending markets, smart contracts, crypto applications, like that's the technology that operated, seamlessly during this highly volatile crypto spiral. And so I think the best use cases to compare generally are CeFi lending, which is, the Celsius and BlockFi, as you explained pretty well. They're taking funds from customers saying, hey, we'll go deploy this into crypto and you'll get an 8% yield. And when you want to take it back out, we'll give it to you. That was generally the CeFi approach. And then what they were doing with the funds in the background was less transparent than with DeFi, which takes a similar approach. It says, hey, deposit your assets with us and you'll earn this yield. And then when you are ready to withdraw or redeem those assets, you'll get those back and you'll be ready to go and they'll be there. The difference being is that when you're using a DeFi protocol like Aave and Compound, you're interacting directly with the smart contract, right? It's person to pool lending versus like person to business lending. And so that's really where this breakdown happens. So DeFi lending markets.
There's a Telegram message that says, just tell me you have the money.
Yeah, right.
There's a smart contract that says, show me your money and I'll decide if I'm going to lend it to you. Right. It's in your wallet.
Yes, it's an if-then statement, right? It's literally like if you do not have the required collateral in DeFi, you will not be able to draw loans against it. Just plain and simple. There's no way to get around that. The smart contract logic is embedded in the applications and is immutable and cannot be changed. That's why these iterations of Aave, these very simple kind of deployments of deposit assets into a lending pool, borrow against it. Those, while they've gotten a little bit better at fine tuning risk, the large kind of primitive of it hasn't changed in a few years now because it works. It's, if you have assets, we'll let you borrow against them. If you don't, sorry, not super capital efficient. That's why some people go to centralized finance, because as you said, you can just say, hey, yeah, I have the assets, and they'll give you a loan, and then you hope it works out. But DeFi is very, very much based on real physical, okay, yes, physical is like probably not the right term they use there, but like real assets that can be verified on chain. So there's a few risk management parameters when it comes to DeFi lending. There's collateral factors, right? There's a certain level of collateralization that's required to draw a loan. It's kind of like a home equity loan is probably the best way to kind of describe it, right? You have this asset, you can draw a loan against it up to a certain value. And if the value of the home or the collateral falls to a certain point, the lending protocol will seize your collateral, sell it, and repay themselves, right? That's kind of what happens with mortgage-backed loans that go into default. So, or home equity loans that go into default. And so it's just happening through these smart contracts that are constantly checking the balances of the collateral and constantly looking at the ratios of loan to value, right? Or how much borrowing power you've used against the assets you've deposited. And as the assets go up, right, you get more borrowing power. Like that's kind of the beauty of using these assets, borrowing against them. If they go up, right, now you have more borrowing power. You don't have to sell the asset. You have long-term exposure. That has all kinds of tax implications and liquidity implications, but it's great when the assets are going up. When they're going down, however, the system algorithmically liquidates itself or the users until it gets back into sync. And so that's what the collateral factors are really important for. It says that, hey, if you deposit $100, you can borrow up to 80 against it. But if that $100 falls, we're going to start selling it to pay ourselves back. CeFi lending, as we saw, had a similar setup. For example, you could borrow against your assets with like Voyager or Celsius, right? However, the insolvency came on the lender's part and not on the end user's part, right? And that's where you saw a big difference. Like DeFi protocols inherently are solvent because they're over collateralized. These CeFi, and they take into account volatility, liquidity, right, and market behavior. Like those are the factors that that risk management in DeFi pays attention to. And it's just very clear that CeFi didn't pay attention to all of those factors. And it became a big issue. So
yeah, and as we keep saying, a lot of people really started understanding the term counterparty risk.
Mm-hmm.
Couple months, right? The idea that honestly, when I deposit my money in a bank, I kind of don't care about the counterparty risk, right? Because there's all sorts of regulations around it. And we built all that over time. When I deposited my money into, so I kind of have that feeling of when I deposit my money somewhere and they have a legitimate website and all that, that whatever they're going to do with it on the other end to pay me my money is somewhat legitimate, right? Like there's someone on the other side, and what we learn is that the banks have insulated us so much from whatever's happening on the other side, either because of regulation or, well, mostly because of regulation, but also often because they have decent underwriting, right? They really go through checks and balances. They don't just send you a telegram message and just say yes or no. And so, you know what, for as much as we complain about banks, they serve quite a purpose there, right? And the regulation serves quite a purpose to protect us from that. And again, we've all had to learn about counterparty risk recently. And that counterparty risk says, I don't know what Celsius was doing on the other side. And even then, whoever Celsius invested in, I don't know that they're going to be solvent, and therefore bring the money back to Celsius, who then pays me. Because just like with the bank, when I give them $1, they don't keep it in the vault with a little note on it that says this is Adam's dollar, right? Celsius didn't do that either. They didn't keep like a wallet that says this is Adam's Bitcoin wallet, right here. They just said, oh, we're going to write you a little IOU, and we're going to promise to pay you at some point when you want to withdraw, unless we don't have it, and then we're not going to let you withdraw.
Absolutely. I mean, you're right. There is a big sense of people, I think, thought that Celsius and these like CeFi lenders were kind of just like crypto banks and had the same risk profiles. And that's definitely not true. And unfortunately, we're finding that some of these firms, users' funds weren't insured, maybe as some users thought that they were. And so there's a whole element of like, if the bank did lose your money up to a certain amount, it is FDIC insured, right? So even if you don't understand what they're doing with it, you have this level of confidence that, okay, like I'll be able to get my assets back. I think that false confidence existed with some of these CeFi lenders, and people didn't take into account counterparty risk. But yeah, if you were lending to a friend, you would absolutely, or like someone you didn't know who's asking about money, you would absolutely ask them, what are you doing with the funds? Like, how liquid is the activities you're going to do? What's your plan to pay it back if I need it all of a sudden, right? You'd have all these clauses. What assets can I seize if you can't pay me back, right? That all would take into account. And I think that it gets kind of abstracted away with a lot of these centralized institutions coming in and acting as a bridge, and people aren't fully aware of their risks. And so, yeah, it's quite sad. It would be really unfortunate to be someone who got excited about crypto and used one of these platforms and woke up one morning and was obviously worried about, there could be a recession coming, inflation's crazy, let me look at my account, and all of a sudden it's like, boom, you can't access your funds. Like,
yeah, it's not just the account's down in value, but you can't even get them, right? Which honestly, for some people probably saved them, because a lot of people were probably going to sell their Bitcoin at like 17,000 or something the day of the drop. And then here we are at like 22, and it probably, I always joke that having a Ledger wallet has probably saved me from myself quite a few times, because it's a pain to go trade it. Right?
Oh yeah.
So, well, I'm not going to sell anything right now because I physically can't, because my Ledger is not in the room with me. I want to, you touched on a few things, Ryan, that are kind of important. One is we have these DeFi systems that have worked beautifully, right? Part of it is this transparency. We've seen where the liquidations will happen. Celsius knows where their liquidations will happen. Voyager knows where they will happen. And they know they have to pay them back. There's no negotiating. There's no like, hey, can you extend me another 20 days or something? It's, you either pay it back or your funds are gone. Your collateral's gone. Had to pay it back, which is beautiful. But as we said, it also leads to an inefficiency of capital. You have to provide, 150% collateral. So is that just what we're going to have to live through with DeFi, or do you see a time when we can turn that and maybe only have 100% collateral? Knowing, because a whole lot of people in DeFi, well, some people in DeFi are trying to get to this idea of under collateralized lending. However, we know in the traditional world, there isn't that much under collateralized lending, right? I mean, my home is, from day one, it's, I'm only borrowing 80% against it from day one, right? And over time, as I build up more equity, my home hopefully goes up in value. The bank owns has a piece of collateral that is worth well more than what I owe. And they can take the house if I don't pay what I owe, right? They can take the whole thing. So most of lending is over collateralized anyway. So one, what is this push in DeFi for under collateralized lending? And is there a way you see that we get there? Or is there a need for it? Or do you go, look, this is the system. This gets more people all over the world into it in a safe way, because so many people all over the world have never participated in a financial system of any sort. And therefore, let's make sure they all stay safe. Let's make sure that everybody gets in a way that's over collateralized. If they want to do something that is, that is under collateralized, that's where we're still going to have some bit of a centralized finance system. And that's still going to be, I'm going to go to someone I know and borrow money. And that someone I know could be called a bank that actually has funds. But is this just how the DeFi system is going to operate? Because that's how it's efficient.
Yeah, it's definitely something that there's been a ton of attention on across the DeFi community, and it is important. I think the reason that there's such a high emphasis on trying to find a way to have, just one-for-one collateralized lending or under collateralized lending is because the traditional system works heavily on, as you mentioned, collateralized lending and credit-based lending, right? And with on-chain, anonymous kind of pool, a person to pool lending, it's hard to have that credit worthiness, especially because I could have wallet A, and if something happens there, I could go spin up wallet B somewhere else, right? And the lending protocol might not know that those two addresses relate to one person, right? So they can't really do a credit check, is what I'm trying to get at. And so without the ability to do credit checks, without the ability to expand your reach through regulations and being able to seize assets or garnishing wages, right? DeFi has fallen into or defaulted to over collateralized lending. I think that it's going to end up that we'll land somewhere around less over collateralized than we are today, but still 100% collateralized or more. We're seeing with like Aave, the new iteration of Aave, they have like higher capital efficiency toggles that you can put on for certain assets, right? So you can maybe borrow up to 99% against your stable coins versus only 75% against ETH. Still over collateralized, right? But you're seeing that window kind of close, or isolating risks so that if there is under collateralized lending for certain types of assets, the insolvency risk is isolated to that specific lending pool and isn't kind of shared across the broader lending pool. So there's a few things people are doing to try to make capital efficiency more approachable in DeFi. But I think it comes down to knowing that a lot of institutions and institutional capital is going to try to find the most efficient landing place. And unfortunately, that landing place isn't in crypto when it's requiring such high collateralization. And so I think a lot of the energy around trying to find ways to introduce under collateralized lending or credit-based lending into DeFi is to try to just onboard more users. And I do think it's important, but the reality is that it's not worth undermining the entire resiliency of the system to try to do that. And it likely will be that there are banks or CeFi institutions in the middle that are underwriting consumer debt and doing due diligence on their end, and then bringing that money into DeFi themselves, or allowing those users who don't have collateral, right? Because I think one of the big things is that not everyone has collateral. Like, it's great to say that DeFi helps all the unbanked people in the world, but if you have to have $1,000 to borrow 500 in a crisis, like that's not the situation that most of the unbanked people we're talking about will be in. It's largely like, great, I have access to financial services. Oh, wait, now I have to have capital to like use them. It's kind of falling short. So I think it's bringing institutional capital, trying to find use cases that actually do bring DeFi and crypto to the masses in an approachable way that isn't just for people who were lucky enough to get into crypto early and have assets, or the Western world who maybe has some savings and can convert those into collateralizable assets, right? So yeah, it's important. I do think we'll land in a middle ground, though. I don't think that we'll find a world where majority of lending in DeFi is under collateralized. It just hasn't proven to be a solvent, solvent structure in the past.
So something that I know you all do at Bitwise, and you're looking across all these different protocols and seeing what's happening in DeFi, but really what you're doing is you're investing in the tokens that represent a lot of these protocols. So obviously we've seen the big names that, Maker, Compound, Aave, like they performed really well here. So when you're looking to invest in, and I know some of the others that kind of start up, I guess if you can call them a startup, right? They have to have some way to generate liquidity. And unfortunately, a lot of that has been some sort of incentive to do so, and with giving away tokens or whatever. So when you're looking at analysis like that, do you feel like there's anyone that can come up, any protocols now, like a way for a protocol to come up and challenge those big names now, or if they cemented themselves through this crisis that say these are the big names now, it's going to be really hard to unseat them, and therefore have they become almost the too big to fail, like whatever Aave and Compound and Maker do, like that's how we're all going to have to do it.
Yeah. I do think there's something to be said here around not all DeFi lending protocols made it through this crisis, and the ones that did are those blue chips like Aave, Compound, Maker, Rari.
Boring, right? The ones that are pretty boring when everything's going up.
Yeah, exactly. The ones that if you look at DeFi blue cap assets over the past year, they've been hit the hardest. Like if Bitcoin and Ether are down 70%. DeFi assets are down somewhere in the tune of 90 to 100, 90 to 99%. And the ones that have been hit the hardest do tend to be those blue chips that have been around the longest. I do think it's because they have a little bit less of that appeal to make those gigantic runs that some of these other kind of long tail assets have. But there is a world to say here that like Anchor, the lending protocol behind UST, and that was part of the Terra ecosystem, did fail. Or I don't know who's going to loan money to Anchor in the future because of the scenario they ended up in. And so I do think that there is something to say around blue chips having the staying power that they operated seamlessly, that they did process liquidations, but that's as designed. It's not, they weren't liquidated like CeFi was, right? They processed liquidations. Those are two very different things. And the blue chips, unfortunately for those smaller, longer tail assets, they're starting to expand onto other blockchains and to layer twos. And so while we have these newer DeFi applications starting to come up and gain a lot of popularity over the blue chip big names, that too was partly due to Ethereum being very expensive and being very popular, and people like looking for lower cost alternatives with higher yield. And we saw a lot of that consolidate back into Ethereum blue chips when everything happened. And I just continue to foresee those being kind of not too big to fail, but like too big to search for an alternative is probably the way that I would put it.
Or they become a composable part of the ecosystem, right? Like we tied with someone else building a product or a DeFi product that just has a little bit bent to it. And some of the ones that I think of are like Maple Finance, which is taking DeFi funds and then actually using an underwriter essentially to go lend out money and separating it into tranches. Or you have something like Notional Finance, which says we're going to fixed time period, fixed interest, but they also use C tokens. So they're using Compound
right
a bit. So they become these composable layers. And now you go, all right, well, we can use what Aave and Compound and Maker and Uni have done, and we can kind of build on top of that and build something a little bit different to match up what people actually want, because not everyone just wants to put their money in Aave and wants to be able to take it out anytime they want and is going to get a lower interest rate because of it. They might go, I want to lock up my money for a year and I'm okay with locking it up if I get a higher interest rate for it.
Yeah, it's a good point. I think tranche lending is another one that could grow into a bigger part of DeFi, where exactly that you understand the risks of the different pools that you're deploying to, and that maybe there are different, like maybe there's an ETH pool on Aave that is like, I don't know, A-rated debt, and then there's a B-rated and then C-rated, right? And those have varying interest rates, but the users at least understand that going into it, or know those trade-off risks. And I think naturally you would find more liquidity sitting in the A-rated debt, and like more people going there, which would likely lead to higher yield in the lower rated and higher risk tranches. But I do think that it's definitely very possible. And the composability of DeFi really can't be understated. I mean, what you can do by stacking these protocols together, as you kind of referenced with Notional, or like what Pool Together, the no loss lottery, does by depositing assets in Compound, generating yield to then give away to people in their like no loss lottery giveaways, right? That all is part of the ethos and the beauty of money Legos.
So, all right, man. Well, we're right up against time in just a couple minutes, and I really appreciate your coming on. Love talking about this stuff. It doesn't matter if anyone's watching us or not. I can talk
Yeah.
about this all day long, and really appreciate what you are doing, you and your analysis, and what Bitwise is doing to kind of help people be able to invest in the new asset class and do so in a safe, secure, compliant way. Anything else you want to leave us with here before we sign off?
Yeah, no, I appreciate it very much. I also could talk about this all day long, so I appreciate people staying with us as we dive into the weeds and then zoom out a little bit. Hopefully, that was interesting to follow. Yeah, I would just say that not all CeFi I mean, we did talk a lot about how CeFi is not much different than TradFi, I guess, from a risk management perspective. I would say that there's a spectrum, and there are a lot of solid CeFi firms out there that do a lot of great counterparty risk, and I don't think all CeFi companies are destined to fail or anything like that. It's just on the spectrum of crypto, and we happen to be like more deep into the DeFi spectrum of it. But it's all very interesting, and I'm very happy to see that DeFi has emerged, from the ashes, kind of unscathed, and that it proves, it just battle tests and proves some of the staying power of these big blue chips. It's really tough time to go through, but really great for the ecosystem.
Ryan, thanks so much. Ryan Rasmussen from Bitwise Asset Management. And we will have all sorts of links for where people can find you and where people can find Bitwise, and how, of course, most of the people watching this will be financial advisors and financial professionals. And so we obviously want them to check out Bitwise and learn about how they can get a hold of the funds, and the now also managing SMA manager as well, right?
Yeah. Yes, definitely. Head on over to the Bitwise site. All of our research is published under the Insights page there. We have, one-on-one white papers, the crypto or the CFA guide to crypto assets, all that stuff's there. And then, a variety of our indexes and different types of offerings are there as well. And would love to connect with anybody and continue discussing this stuff.
All right. Thanks so much, Ryan. We'll do it another time when you can. I appreciate it. We'll do another time when you and I can just riff for a few hours, probably, and about how much we love decentralized finance.
Yes, looking forward to that. And thanks again for the opportunity. It's been awesome.
All right. Thanks, Ryan.
Thanks.